New Year's resolutions are a great way to start fresh and set ambitious goals. For investors, these resolutions often focus on building wealth, improving financial habits, or expanding investment knowledge. However, many people find themselves abandoning their resolutions within weeks. I read a statistic that said that 92% of New Year's resolutions fail by January the 15th. Why does this happen, and how can investors set themselves up for success? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. In this video, we'll explore the most common mistakes investors make with their resolutions and provide practical steps to set goals that stick. The common mistakes investors make with their New Year's resolutions. Vague goals. Many resolutions sound like this: make more money in the stock market, or invest smarter. While well-intentioned, these goals are too vague. Without a specific target, it's hard to know where to start or how to measure success. Unrealistic expectations. Resolutions like double my portfolio in a year are exciting, but often set investors up for failure. Ambitious goals can lead to high-risk strategies, unnecessary stress, or disappointment. Setting and forgetting. Writing down a resolution like contribute to my stocks and shares ISA is a good start, but many investors fail to follow through or review their progress throughout the year. How to set better investment resolutions. Firstly, you need to be specific and measurable. Instead of vague goals, set resolutions you can actually quantify. For example, a bad goal is save more money. This lacks clarity and leaves too much open to interpretation. You're unlikely to know when or even if you've succeeded. A better goal could be contribute £500 per month to my stocks and shares ISA. This is actionable and measurable and with a clear target to work towards. You also know if you've achieved it very obviously. Clear measurable goals make it easier to track progress and build momentum. By defining specifics such as amounts, timelines, and actions, you not only make progress more tangible, but also ensure accountability. For instance, breaking this goal down further, like saving £125 per week, or cutting monthly expenses by a set amount to free up cash for investment, adds layers of achievability. Specific goals also enable you to identify when adjustments are necessary, fostering a proactive approach rather than reactive guesswork. That's why on the Dividend Academy, one of the first homework activities is to set a SMART goal: specific, measurable, achievable, relevant, and time-bound, around what you want from investing. You can also view other students' goals for ideas. I really think it's important to have a solid goal and know which direction you're going before you get started. The second thing you need to do is focus on long-term habits, not short-term outcomes. Rather than aiming for specific returns, focus on habits that will build your portfolio over time. For example, commit to reviewing your portfolio quarterly, automate contributions to your investment accounts. Targeting specific outcomes, such as achieving a certain percentage return, is often counterproductive because market performance is mostly beyond your control. Instead, prioritize actions within your influence, like diversifying your portfolio or regularly assessing your risk tolerance. Habits are more sustainable than outcomes that depend on unpredictable market performance. The third thing to do is align your resolutions with your financial plan. Your resolutions should align with your overall financial goals. For example, if you're planning for early retirement, consider resolutions like increasing pension contributions to maximize your tax relief, or rebalancing your portfolio to reflect your risk tolerance and time horizon. Good example would be if your goal is to retire early, you might resolve to increase your monthly pension contributions by £200. This aligns with the broader financial goal of building long-term wealth for retirement. A bad example would be resolving to invest all your savings in a speculative stock to retire in 5 years. It's not aligned with a sound financial plan as it exposes you to unnecessary risk and neglects diversification. It might be tempting to do something like this when you see others making big returns, but not really a sensible goal. The fourth thing is to prioritize learning. Financial knowledge is a powerful asset. Set goals to expand your expertise, such as reading one investment book per quarter, or subscribe to new YouTube channels. A good one I've heard of recently is called the Dividend Experiment. I really like the cut of that guy's jib. I think there's two ways to take this. On the one hand, YouTube and similar make it easy to digest investing concepts, but there is a limit to what you can learn from that type of content. I will go into this in a later video, but YouTube videos are optimized for views rather than learning resources, so there is a need to look elsewhere at more formal learning avenues too. Learning boosts confidence and ultimately leads to smarter decision making. Then the fifth thing is to incorporate flexibility. Market conditions can change rapidly, so it's important to strike a balance between flexibility and discipline. Instead of rigid goals, commit to reassessing your strategy as needed while staying consistent with your overall plan. For example, instead of something like invest £10,000 in equities, aim for invest £10,000 into a balanced portfolio while regularly reviewing allocations based on personal risk tolerance and financial goals. Flexibility allows you to adapt to changes in the market, such as economic downturns or shifts in interest rates, ensuring your plan remains relevant. However, discipline is equally vital. It ensures you stick to your core strategy and avoid knee-jerk reactions that could derail your progress. For instance, regularly contributing to your investment account, even during market volatility, builds long-term resilience and growth. Balancing adaptability with commitment is the key to achieving sustainable financial goals. Steps to keep resolutions throughout the year. Even the best resolutions can fail without a solid plan to sustain them, and here's how to stay on track. Break the goals into smaller milestones. Big goals can feel overwhelming, but breaking them into smaller steps make them achievable. For example, if your goal is to save £10,000 this year, focus on saving £833 per month, or £192 per week. Breaking down a goal into manageable pieces ensures steady progress and reduces the stress of achieving it all at once. Additionally, smaller milestones provide frequent opportunities to reassess and celebrate, which keeps motivation high. Track progress regularly. Tracking your progress is critical to staying on course. Whether you monitor contributions to your savings accounts, or assess portfolio performance, or review budgeting practices, regular check-ins provide clarity on how well you're adhering to your goals. Consistent tracking also allows you to identify any gaps or setbacks early and take corrective action. Tools like spreadsheets or digital financial trackers can simplify this process, but even manual reviews of your accounts can be effective. Build accountability. Sharing your resolutions with someone else can make a significant difference. Whether it's a trusted friend, a family member, or a professional advisor, accountability partners can provide encouragement, reminders, and constructive feedback. For instance, discussing your goals with someone who shares similar financial ambitions can foster mutual support and accountability. Additionally, scheduled check-ins with a financial advisor can help you stay aligned to your long-term strategy. Celebrate wins along the way. Recognizing your progress and celebrating small victories can make the journey enjoyable and reinforce positive behaviors. For example, if you successfully max out your yearly savings limit or diversify into a new asset class, take time to acknowledge your efforts. Celebrating doesn't have to be extravagant. A simple reward or even just reflecting on your achievement can boost morale and motivation. Regular celebrations ensure you stay engaged and appreciate the value of incremental successes. The FIRE, Financial Independence Retire Early subreddit, is a great place to share and celebrate milestones. Members frequently post about their achievements, whether it's reaching a savings goal or taking significant steps towards financial independence. The supportive community provides encouragement and inspiration, helping you stay motivated to keep going on your journey. Likewise, the Dividend Temple Discord has a big wins section where members share their financial milestones. Whether it's hitting a new dividend income target, making an important investment, or achieving a long-term goal, this space provides an opportunity to celebrate those victories with like-minded individuals. Sharing your success in a community like this can boost your motivation and foster a sense of camaraderie as you continue your financial journey. By sharing your wins in these communities and taking time to celebrate your own progress, you reinforce positive behaviors and remain energized on your path to financial independence. Financial resolutions require flexibility to remain relevant. Conclusion: New Year's resolutions for investors don't have to be another set of broken promises. By setting clear, actionable, and realistic goals, you can turn your resolutions into meaningful progress towards financial independence. Now remember, success isn't about perfection, it's about consistent improvement. Take the first step today by setting one realistic solution and committing to it. With discipline and a solid plan, this coming year could be your best financial year yet.
This video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!